You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have British American Tobacco, Redrow, Unilever, Barratt, PZ Cussons, and our US company of the week is Kraft Heinz. Sam, shall I kick us off with British American Tobacco?
Absolutely. We've not covered them for a couple of weeks.
No. Well, they've had their full year results out. And for anyone who doesn't know, British American Tobacco is the UK's largest tobacco company and owner of Lucky Strike, Kent, Dunhill, Pall Mall, amongst others. British American Tobacco's full year 2023 revenue grew by 3.1% organically to £27.3 billion when ignoring the effect of currency movements. They had 21% growth in new categories, such as vapes, which was the main driver of growth. But for reference, volumes were down 8.2%, so really quite significant in the combustibles. Underlying operating profit rose in line with sales to £12.5 billion, and free cash flow increased by 3.9% to £8.4 billion, and net debt at the year end was £34.6 billion. Dividends for the year were up 2% to £2.35.5 per share. And for 2024, British American Tobacco is expecting low single-figure growth for both organic revenue and underlying operating profit, with performance to be weighted towards the second half. The shares were up 6.7% in the early trading. In terms of valuation, British American Tobacco has a market cap of £53 billion and trades at 6.2 times forward earnings. That compares with a 10-year average of 12. It's got a prospective dividend yield of 10.6%. I think these results are similar to what we've become used to, really, certainly in terms of the revenue growth. And again, new categories, which is largely their sort of non-combustibles in the form of vapes and smokeless tobacco, seem to be doing pretty well with the revenue growth of 21%. I suppose that's, as we're seeing, increasingly where the future of the business is. I think one thing that did strike me was just quite how rapidly the combustibles are dropping off now. So 8.2%, it's an awful lot. I think we'd really got used to it being kind of between the 3 and 5%, but this was much more significant. Profitability of the new categories has moved forward. So I think they're expecting it to be profitable this in full year 2024, which was 2 years ahead of what had been expected. I think one of the issues, this is kind of going back to the combustibles that they're seeing dropping off, is that when they bought Reynolds Tobacco in 2016, and that was essentially almost, well, vast majority of the revenue was US with Reynolds. Now that you're seeing that the developed markets drop off more significantly with the volumes decline in the combustibles, that's feeding through. And I would have thought quite concerning for the business, in that whilst new categories are going well, they're not quite there yet, and certainly not to really drive it forward when volumes are dropping that quickly. That being said, it's still hugely profitable. I mean, underlying operating profit of £12.5 billion, and the dividend being very, very chunky. And I know the share buybacks, but a lot of this being returned to shareholders. And still it does look like the business has a future in terms of the new categories. So I would say overall positive. However, it is slightly concerning for the health of the business that their combustibles are dropping at quite the rate that they're dropping, even though they've managed to offset it with prices. If you're dropping that quickly, how long can you keep that up for? I think that would be the issue. That being said, I suppose a lot of people would be buying these shares more for how much cash is being returned. And well accepting that it's a business in structural decline, and if it has any form of future in the vapes, that's just sort of a bonus. Yeah, I think that would probably be how I'd sum it up. And I mean, it's still got operating margins of above 40%, which of course is very impressive. I don't think we'd ever see a drastic re-rating of it, and it's the ESG and ethical concerns with it are limiting and have led to sort of sell-offs, for the company from an institutional point of view. So I don't think, even if some people in the market take a different view of it, that we're going to see a massive re-rating of this stock. Sam, what are your thoughts on these full year results?
Pretty similar. I would echo that over 8% volume drop off is high, and there's only so many years you can have that. But they have grown revenue and they have grown the operating profit. So it's not really stopped them. So although it's larger volume drop offs, they are still continuing to do what we've seen as long as we've been covering them. I agree. I think there's slightly more risk baked in now, just because if that volume decline does continue or even accelerate, eventually it does just become unaffordable, you'd think. But I don't know, maybe if you'd gone back 10 years and sort of looked at what the cigarette prices would be now, people would have just thought, well, no one's going to be buying those, but clearly they do. In exchange for that risk, though, that is why you're getting it at a forward P of 6, which is basically half the 10-year average, and you're getting it a dividend yield of over 10% compared to 6% as a 10-year average. So I think you could argue it is priced in that it stays at 8%. If in 5 years' time it's still putting out similar results, I don't know where the share price would be, but you'd have had half your money back in dividends. So and then, like you say, it does have a future with the combustibles. That's now going to be contributing to profit. There's also possibly an argument that as the governments are clamping down on the disposable vapes, it's not a good thing, but could that push more people back towards cigarettes? And there is a possibility that, because a lot of this volume drop off, it won't be people completely giving up smoking. It will be people moving to the non-combustibles. And if you bring in legislation that slows down the non-combustibles, obviously in terms of public health and stuff, I appreciate it's not great, but British American tobacco probably could benefit.
Yeah, and it's interesting because we'd spoken about it with Supreme before, that if this sort of ban goes ahead from a disposables point of view, or that would benefit probably sort of Supreme and then also bigger companies like British American that were less involved in that part of the market.
So, yeah, it's slightly more concerning, but that is why it's so cheap now, isn't it, I guess?
The other thing that was interesting that I saw in the news with British American was, the Russia business that they disposed of.
Yeah.
They did retain options to buy it back. So I don't know whether they only last for 2 years. So it may be that sort of, they do choose not to, and whether they thought at the time things would be resolved sooner than they obviously are transpiring to be, but they did retain those options. And I think, didn't know whether it accounted for about 3 to 5% of revenue. It was something, it wasn't insignificant. But anyway.
Well, I think if you go back 2 years, people did expect the Russia-Ukraine situation to be over in about a month. That was the general consensus.
Yeah.
So 2-year options didn't seem like a terrible idea, but I suppose from their point of view, retaining the options isn't going to make their ESG score any worse. So.
No, that's true. That's true. Okay, on to Redrow then.
Yes, so first of 2 house builders this week, and Redrow have come out with half-year results. So they've not, which I don't like, but in the results, they've not given the percentage changes. I've not bothered to calculate them because we're going to do Barratt Developments later on, and they're pretty similar. And also, you can tell they're quite easy to work out. But revenue is down from just over 1 billion to 756 million. So that's about 25% drop. Operating margins down from 19.3 to 11.4%. Profit before tax is down by over half from 198 to 84 million. Earnings per share is down from 45.4 to 18.7p a share. The net cash position is up from 107 to 121 million. The interim dividend per share has been cut as it's paid out based on profits from 10 to 5p a share, and the current order book is down from 1.1 billion to 800 million. They've put this down to the subdued housing market, which I think is pretty reasonable. They've said macroeconomic headwinds have led to a sales rate of 0.36 private reservations per outlet per week for the first half, and that compares to 0.38 a year ago. So it's not actually down that much. I think it's just because of the order book. It's just starting to flow through from 6-12 months ago. They've said they've had an encouraging start to the second half with significant increase in visitors, resulting in private reservations per outlet per week for the first 5 weeks of 0.52, but that's only up from 0.51 a year ago. 2024 guidance, they've guided for revenue of 1.65 to 1.7 billion and underlying profit per share of 180 to 200 million. We will go into it in more detail, but these results have been slightly overshadowed by the... Has it been agreed, or is it still going to the shareholders?
You go to shareholders.
Right, so there's a takeover offer from Barratt Developments that's going to shareholders, which I will cover in slightly more detail, although not loads, as part of the Barratt Development results. In terms of the valuation, Redrow trades at a P of about 10.4 now. I haven't bothered to calculate the dividend yield just because if it gets bought by Barratt, you're not going to get any dividends from it anyway. So that was my thinking. I thought I'd save myself some time. I think these results are not good. However, it's what we expect. We know this is a cyclical business. And really, the main thing is whether it's going to continue to trade, which we'll talk about a bit later on. But John, as a Redrow shareholder, what do you think of these results? And could you refrain from talking about the Barratt offer until we do the Barratt results?
So I think these results are the sorts of things we've come to expect from the house builders at the moment. I'm not too troubled by them. Obviously, you'd always like to see growth, but it's a cyclical company. And I think with the mood at the moment, and I know inflation figures and Bank of England's interest rates decisions are widely speculated and people are hoping for sort of cuts sooner. But it feels like both sort of major parties may well have some sort of policy. And I'm not saying whether this is good or bad, but to sort of stimulate the housing sector, get more people on the housing ladder. And again, not saying that that's good or bad, but I think companies like Redrow are going to be the beneficiaries of it. And if you do see interest rates coming down, the cycle turning, I think these figures could very soon go very positive again. And rightly or wrongly, the big builders making an awful lot of money. So in summary, I'm not too concerned about these in the short term. I think we are going to see a change.
Right. Should we move on to another one of your holdings?
Yes. So Unilever, favourite of the show, UK's largest consumer goods company. It's owner of Dove Soap, Ben & Jerry's, and many, many more. They had their full year results out last week, with the group reporting full year sales of 59.6 billion euros, down 0.8%, largely as a result of negative currency moves. Underlying sales growth of 7%, with volumes up 0.2% after returning to growth in the fourth quarter. And the group's 30 power brands drove the performance, with sales growth of 8.6% over the year. Underlying operating profit rose 2.6% to 9.9 billion euros, with margins improving by 0.6 percentage points to 16.7%. And free cash flow was up from 1.9 billion euros to 7.1, and closing net debt was 23.7 billion euros, which was in line with last year. For the coming year, Unilever expects to see underlying sales growth of between 3 and 5%, and a modest improvement in underlying operating margin. The quarterly interim dividend for the fourth quarter was maintained at 42 cents a share, and a 1.5 billion buyback was announced, with plans for it to commence in the second quarter. And the shares were up about 3.8% in early trading. In terms of valuation, the group has a market cap of £100 billion and trades at 16.6 times forward earnings, compared with a 10-year average of 19. It has a prospective dividend yield of 4%. And obviously, we've got that €1.5 billion share buyback that's going to start soon. I thought these results, I thought they were fair. It was good to see that volumes are now, albeit modestly, rising, and that there was underlying sales growth of 7%. Difficult and not a lot they can do about the currency moves. To me, there were some signs of progress, and I appreciate management has changed, but it's still very early days and a long way to go. I think there's some things that are slightly concerning, but the group are looking to address. So some of the core brands, they only had 37% of those winning market share. So most of them, the majority, not, and losing market share. Group are addressing that. They're investing more in the marketing, and that's risen and now stands at 14.3% of revenue. So that's, I suppose, looking to the long term. I think it's still a long way from getting to the consistent 3 to 5% of sales growth. And ideally, you would hope from a company of Unilever's quality that you'd be getting higher single digits. And again, that's even further off. So I think there's a lot to do, but it's early days with the new management. I don't think it's particularly expensive given that. So I think it would be fair enough to buy it at 16.6 times forward earnings for, with a longer term view. And then hopefully we'd sort of see the re-rating and, ultimately get to the sorts of levels that and figures that Nestle are consistently achieving. That would be the hope. But yeah, still a long way to go, I think.
I would echo that. I mean, down 0.8% revenue is not great, but it is mainly negative currency moves. If you look at the underlying performance, the sales growth is very good. I think it speaks to the pricing power, particularly of the power brands. And if they've done that without losing volumes, I think it's a pretty decent year. I don't think the debt's too concerning now. Underlying operating profit 9.9 billion compared to debt of 23.7. So it's 2.5 times the net debt. It's not terrible. And yeah, I think compared to some competitors, it's pretty reasonably valued given the quality of the brand you're getting. You're getting a decent dividend. I know it's not as good as it used to be now. Interest rates have gone up. And the issue is this has been an issue for years, and it goes back to the previous management team. But if they can actually start getting these brands to, if they can get the performance to reflect the quality of the brands, I think it's probably underpriced, but I don't know how many years you give it.
Yeah, that's right. I mean, I think one of the things about it is that in terms of management, we've only seen kind of radical changes more recently, kind of in the last year. Before that, it seemed to be sort of continuity of a strategy that wasn't working very well. So I don't think we'd really had that sort of more radical change and sort of clear out until the last year, really. So I think you could argue that you should give them more time, on that basis, I would say.
Yeah, no, I think that's a fair comment. And I think the underlying figures, if you strip out the currency movements, they definitely deserve a bit of time from that, because we've not, I know it's been in a slightly, it's been in a higher inflation environment, so you can increase prices more. But I do think this is in terms of underlying results, probably as good as, if not better, any of the years we saw under the previous management whenever we covered it.
Absolutely. And they were, in some ways easier times. So, yeah.
And we'll never know, but I think previous management in the current year, based on what we'd seen historically, I think they could have got the same growth figures, but I don't know if they could have done it without a drop in volumes.
Yeah.
And we'll never know.
We'll never know, no. But there seem to be just splurging on all sorts of different brands without much thought going into them. And yeah, I don't know. It felt almost a bit like Tesco was in I suppose, the early 10s. It had that sort of feel about it. And then it did need someone like, Dave Lewis to come in and just sort it out and get back to I suppose, in Unilever's case, the core brands and getting back to basics, really.
Did you see Tesco sold their bank the other week?
I did. I think Barclays bought it, which, and I appreciate it was one thing that you didn't like about Tesco.
Yeah, no,
yeah. Now they've got rid of it.
If we'd been covering them, if they'd been on the back of some results, they'd have got some brownie points for that. But,
yeah.
Just thought I'd mention it.
Yeah. Well, it's a good point, isn't it? That is they're going back to, what they should be doing as a supermarket.
Yeah, and I think with Unilever, obviously, they've got so many powerful brands. If they are just focusing on what they're now calling the power brands, I think that's the right strategy, because
Yeah.
there's no point going out. And I think if you compare Unilever to, say, AG Bar, which we covered last week, now AG Bar has some good brands, but it's not got loads. So I
Yeah.
think when AG Bar in the last few years have gone out and bought like the oat milk business and Funkin' Cocktails, I think that's the right move for them to go out and build that portfolio of brands. Now, if Unilever are going out and splurging on similar kinds of businesses when they've got so many quality brands already that aren't performing, I do think it's short-sighted. And I do agree with the strategy of, actually, let's focus on the brands we've got, because you're not going to be able to buy better brands than what you already have anyway. And if they're not performing, that does need to be the focus of management's attention.
Yeah, no, completely agree. And I suppose it's nice as well that you've got a well-covered dividend of 4%, which is, pretty decent.
And a little buyback as well.
And a little buy, yeah. Well, I suppose for Unilever, it's a little buyback, but
it takes you to what's the market cap now? Is it about
100 billion? Yeah.
Yeah, so it's like another 1.5%, isn't it?
Yeah,
So,
yeah.
So it takes you to about 5.5%, which isn't terrible.
Not terrible. All
Should
right.
we move on to Barratt?
Yeah, so completing the second half, really, isn't it?
Yes. So Barratt Developments, who are significantly larger business than, well, not significant, they're about twice the size of Redrow, maybe a bit more than that. They have come out with their half-year results, and revenue was 1.9 billion, which was down 34% on the previous year. Underlying pre-tax profit fell 69.9% to 157 million, largely due to a 28.5% fall in the number of houses sold. Operating margins fell from 18.4% to 8.4% as cost inflation remained and house prices continued to soften. The order book moved lower, down from 2.5 to 2.1 billion. Net cash of 753 million has moved down 215 million from December 2022. There was a free cash outflow of 78.6 million due to lower operating cash flow, and the prior year saw an inflow of 184 million. Reservation rates and buyer sentiment appear to be improving, and that's been helped by the expectation of lower interest rates and the introduction of better mortgage deals, and management did seem upbeat. Now, the big news was that they have announced they've agreed an all-share offer for the combination of Barratt and Redrow, and that deal values Redrow at more than 2.5 billion, which is a 27.2% premium on the share price when it was announced. The board have declared an interim dividend of 4.4 pence, down 57%, and the current trading outlook is uncertain, although, as mentioned, management are now encouraged. And the shares fell 6.3% following the announcement. In terms of the Redrow deal, the Redrow band does focus on larger, higher quality homes, which Barratt do currently serve through the David Wilson Homes brand, and they are expecting annual cost savings of around 90 million due to the synergies this will create. They've said if build cost inflation does cool to 5%, which they've suggested in the guidance, and the cost synergies come, that could help get the margins back up, but there is no guarantee that will work, or that inflation won't get worse, or that house prices won't continue to push the margins, even if the cost prices stay the same. In terms of valuation, Barratt trades at a price to book of 0.9. That compares to a 10-year average of 1.2. Prospective yield over the next 12 months is 3.5%, and that compares to a 6.2% average. In terms of the PE, Barratt's taken a much larger hit because the profits are down 69.9%, but last year it looks like most of the profits were weighted towards the half that's just been. So they're actually now trading at a PE of 22, and that compares to a historic PE of 7 if you look at last year's results. However, same comments as Redrow would apply. I think this is a cyclical business, so it's not something I'd be too concerned about. I think the main news really is these results. You can probably just echo what we've said about Redrow, but it's really the Redrow deal that's, I think, worth talking about. My view is it is a very cyclical business. So Redrow was, prior to this announcement, I mean, it was down from where it was like a year or two ago. It wasn't down loads, but I just think it's a cyclical business. We've seen some drop in the valuation for Redrow. I don't know. I think if I was a Redrow shareholder, and I'll be interested to see what you think as a Redrow shareholder, John, I think in terms of, if you're going to get shares in Barratt instead, I think you're probably getting a very similar business. Like with the house builders, they are all pretty similar. I have always liked Redrow. I think they have been a smart operator, but I think we've always liked Barratt as well, in fairness. But I think Barratt are probably getting the better end of the deal just because the premium's not huge. The share price is trading. It would just value the shares where they were 2 years ago. It's a cyclical business and they're buying it, in probably the best part of the cycle to buy it. But if you look at the long-term tailwinds that the business potentially has, it's the same for both of them. But if I was a Redrow shareholder, I wouldn't be gutted if Barratt bought me out, because you are getting a very good business in exchange if you're getting paid in shares. But I don't feel like the full value of Redrow has been unlocked. I think it's probably worth more than what they're potentially getting it for. So I think I'd probably reject it if I was a shareholder. So what do you think, John?
Yeah, I take your point. I think because it is an all paper deal, and you're obviously getting a very well, not very similar, but fairly similar company. You're getting it at where it is in the cycle as well. So it's sort of reflected, if it were a cash deal, I think you'd look at it differently, because you'd think, well, I'm not, I'd rather just hold on to these shares and wait till we're in a better part of the cycle. I don't know. I think I'm okay with it. I know that Steve Morgan, who's the founder of Redrow, and has about, I'm not sure, there's 16%, something like that, fairly significant shareholding. He's backing it. Yeah, I hear what you're saying about the premium, because I think if it's worth 2.5 billion roughly, then the shares would be around the £7 mark. And as you say, if we looked a few years ago, so when everybody was very optimistic, Help to Buy was going on, and Brexit had sort of, in inverted commas, been sorted. So we're sort of that early 2020 period when the FTSE was having a big rally prior to COVID. The shares of Redrow were, I think, around the £8 mark. So it's not quite there. But I think where we are in the cycle, you're getting a significant premium and you're getting quite a similar business. It's all paper. So, yeah, I'd probably go with it, actually.
So then you would vote for it?
I probably would vote for it. But as you say, it's. I think if it were another type of company, and if it were, say, cash, I don't think I'd like it as much, funnily enough.
But then what's the difference? Because if it's, say, I don't know whether it is or not, but if it's held in an ISA, you're not going to pay any tax anyway. You could just take the money and go out and buy Barratt shares the next day.
I suppose, yeah, no, and that's I suppose that's a fair point. And synergies wise, maybe there's some. I note that if this goes ahead, it will make the new Barratt Redrow house builder the largest in the UK. It'll overtake Taylor Wimpey and it'll be the largest. It also, I suppose, it does kind of fit into kind of a Barratt portfolio, in the sense that they have traditionally operated more at the lower end of the market. So then this gives that kind of the slightly higher end of the market. So they'll have everything, really.
I think the synergies are quite achievable, just because sometimes, a lot of the time, I mean, synergy, I know, management's favorite word when they're buying something to justify it. But a lot of the time, you usually have like either one good business and then one business is not so good. I think in this case, it is two good businesses. I do slightly prefer Redrow, but I think Barratt's a good operator. It's a good business. I've never really had any complaints about the way management have run it. I think when you are taking two high quality businesses and merging them, it probably is easier to get those synergies. Whereas if you're trying to merge a good business and an average business, I think a lot of the time it is the average business that will win out.
Yeah. And then if this does go ahead, and then you go into a year and there is more stimulus to the housing market, and this is the UK's largest house builder, potentially with those synergies, you could really see it doing very well in the next couple of years. But that's a big if.
Shall we move back to consumer goods then?
Okay, yes. So not so good with PZ Cussons. We've covered it before and it has been struggling recently. I think it's probably worth giving a bit of the background, more so now than sort of ever, really. So PZ Cussons, it's the owner of brands like Imperial Leather and Original Source. It's been trading in Nigeria since 1899, after being set up in Sierra Leone by George Patterson and George Zagonis. And Nigeria accounts for around 35% of the group's revenue. And it's also worth mentioning, as we sort of touched on last week with Airtel Africa, that there have been changes in Nigeria, the election of President Tinubu, who came to power last year, and that the country has abandoned the Naira's peg to the US dollar. and remove complex currency controls in an effort to encourage foreign investment, which in turn has led to a huge depreciation of the naira, making the currency the world's worst performing foreign currency in the last year. Anyway, with that backdrop, the half-year results came out, and I'll just preface it with Jonathan Myers, who's the chief executive, and he said, PZ Cussons is a stronger business than when we launched our new strategy, as demonstrated in our 9th consecutive quarter of like-for-like revenue growth and on a constant currency basis. Double-digit operating profit growth in the first half of the financial year. We've clearly had our challenges, but have also delivered a turnaround of the UK personal care business and put in place measures to address the underperformance in our beauty business. The most significant challenge we've faced by far has been the devaluation of the Nigerian naira, which today is around 70% weaker than a year ago, representing the biggest drop in the currency's history. As we set out in September 2023, macroeconomic developments in Nigeria would be the key determinant of the full year 24 results. Whilst we continue to make good progress in managing this volatility, the further devaluation in recent weeks will inevitably impact on our full year 24 results. As a board, we have taken the prudent step to reduce the interim dividend in light of the devaluation. As we look ahead, we remain confident about the long-term potential for PZ Cussons as we build a higher growth, higher margin, simpler and more sustainable business. So getting on to the nitty-gritty then, as indicated in previous announcements, the devaluation of the Nigerian naira has a significant impact on our financial results in comparison with the prior year. The foreign exchange loss in the period was £88.2 million and wholly the result of the devaluation of the naira, which fell by 51% between the 31st of May 2023 and the 2nd of December 2023. Statutory results show an operating loss of £89.7 million, have been materially impacted by these foreign exchange losses. Revenue declined by 17.8% from £59.8 million to £277.1 million, of which £52.9 million was attributable to the naira devaluation. Like-for-like revenue growth was 2.2%, driven by price mix improvements of 7%, and a 4.8% decline in volume. Adjusted operating profit margin increased by 110 basis points, with an improvement in each of our 3 regions, driven primarily by increased gross profit margin. Profit before tax declined by 24.3%, reflecting an increased interest charge, but reduction in both the effective tax rate and non-controlling interest as a result of the naira devaluation resulted in a lower decline adjusted EPS of 16.3%. On a constant currency basis, the financial performance has been more robust, with adjusted operating profit growth of 17.2% and earnings per share growth of 9%. In terms of full year 24 outlook, at our full year 2023 results in September, we noted that the Nigerian macroeconomic environment and the currency particularly would be the key determinant of full year 2024 results. Since then, we've experienced further depreciation of the naira, with the official rating falling more than 30% since our balance sheet date, the 2nd of December. As a result, we now expect full year 24 adjusted operating profit at reported rates of exchange to be in the £55 to £60 million range. So an awful lot to take in. So in terms of valuation, the group currently has a market cap of £431 million. There is no PE ratio because it doesn't have earnings at present, and it's paying 1.5 pence a share currently. Share price is down 32% year to date. Over the last 1 year period, it's lost 46%, and 2 years, 50%. Really struggling. I think it does have some strong brands, but as we've seen, they haven't been performing. And then the currency issue has really dominated the headlines. I think if we did look to the sort of more mature markets in Europe and America, revenue dropped 2.3%, which is disappointing. And it had a poor performance of the Sanctuary Spa skincare brand. And also then looking at Asia Pacific, 13.1% decline in revenue. The one positive really was the UK, with a personal care revenue up 2.2% when currency fluctuations are included. I would say that it's currently, for me, uninvestable. I don't know what your thoughts are, Sam.
I think uninvestable's harsh because I think that kind of suggests there's like nothing they can do that would improve it, which I would reserve uninvestable for businesses where no matter what, I would not buy that. It's pretty close to uninvestable. I don't think it's quite there for me. I'd give them some. I mean, it's easy to sit here and criticize the Nigerian naira decrease, but Airtel Africa, which we both own, has had the same problem. And we've sat there last week or the week before, whenever it was, and given them quite a bit of slack. So I think we do have to give the same slack to PZ Cussons, even though we don't own it. So I think we'll put the Nigerian naira to one side. And if anyone wants to comment on that, you can just go and listen to what we said about Airtel Africa last week. But I know you said that with their adjusted operating profit, if you strip out the Nigerian naira, but is their currency losses was up, but that's on the adjusted operating profit. On the operating profit, with the only adjustment being the Nigerian naira, it's actually down 7.8%, so I think the way they've presented that is slightly disingenuous. Now, I don't know what those adjustments are. They could be completely legitimate, but this is not the kind of business where I'm going to go in and have a look because it's just not worth my time because I'm not going to be buying it anyway. I think to be down 7.8%, excluding Nigerian naira, their currency devaluations, is really poor, especially when we look at, for example, Unilever's results, where if you exclude their currency movements, they've had a great year. So I just don't see the excuse. I think some of the brands are decent, but we've covered this for a number of years. They're not getting the results, and they are in a market that is just covered in risk, and they're very heavily exposed to it. Now, Airtel Africa's in that same market, but the difference is they are getting the results, and they are getting results good enough to basically offset the currency decreases, whereas PZ Cussons aren't. If they could have maybe like a year or two of really positive like results where they're starting to unlock the power of those brands, because I do think they have some good brands, I'd possibly take a look at it actually, but for me, it's not the Nigerian naira. It is the underlying results themselves. And this is not, you can't blame the currency movements because we've covered this for 2 years or however long. And there's always some reason why the results are down and they're not unlocking the power of the brands. So yeah, I think uninvestable is harsh because if they could have a good year or two, I would consider it. But yeah, at the moment, absolutely not a chance.
Okay, fine. On to our final consumer goods company of the week.
Yes. So Kraft Heinz, I don't think we've covered it for a while, but it is in our fantasy portfolio and you do own it personally as well. So it's good to check in every now and then. So they have reported their Q4 and full year results. So for the full year highlights, net sales increased 0.6%. And that did include a negative 1.8% impact from the fact there was an extra week in the prior year. Organic net sales increased 3.4%. Gross profit margin increased 280 basis points to 33.5%. Net income increased 20.2%, but adjusted EBITDA increased 5.1%, including a negative 2.1% impact from the extra week in the prior year. Diluted earnings per share was up 20.9% and adjusted was up 7.2%. They ended with a net leverage ratio of about 3x, which I don't think is terrible, actually, considering where they've come from. So we're now onto the Q4 highlights rather than the full year. Net sales decreased 7.1%. However, that did include a 6.1% impact from the extra week last year. Organic net sales decreased 0.7%. Gross profit margin increased 180 basis points to 33.8%. And net income decreased 14.6%. Diluted earnings per share was down 15.3%. And the company announced a $3 billion repurchase program. And that's on a share valuation of 42 billion. So it's not insignificant. That is a decent chunk. If we do the results by region, and there's only 2, but for the quarter, North America was down 9.1% for sales. But for organic net sales, it was down 5.5%. International was down 0.2%, but for organic net sales, it was down 0.6%. And for the full year, North American sales were down 1%, but organic net sales down 6.5%. And international was up 6%, but organic net sales down 2.1%. in terms of the valuation, of business trades at a PE of 15, and it has a forward dividend yield of 4.6%, which for a US listed stock is not terrible. My view is they do have some very good brands, but I think these are the worst set of results I've seen from Kraft Heinz. Now, they might have put out worse ones and we've not covered them, but for me, these are the worst ones I've seen. I think when you look at the quarters or the years or the 6-month periods that the competitors are having, there's just no excuse for this level of drop. And you can blame the extra week last year all you like, which they have been very, very keen to do in these results. I've not seen that from anyone else, really. Any of the other competitors. They've not really had to resort to that because the results are decent enough on their own. I don't think Unilever mentioned it. I don't remember Nestle mentioning it. Don't remember Reckitt mentioning it. And it is in here. I didn't read out every time they've mentioned it, but it is literally in every single line of this report. But everyone else had 1 week less and their results are pretty decent. These results are in line really only with PZ Cussons if you strip out the currency devaluation. So I think these are really, really poor. If I was a shareholder, I'd be disappointed. Yeah, it's the volume drops, really. I think that's really disappointing. And it looks to me like where Unilever was a year or two ago. But I don't know what they do to change it. John, what are your thoughts as a shareholder?
Similar. I mean, I was very disappointed. 7.1% fall in net sales in the final quarter. Sales volumes down 4.4% in the fourth quarter. And then the forecast organic net sales flat to 2%. It's not good. And yeah, I'd hope for much better. I agree with you, this whole business about pointing to having a shorter comparable period, but no. And I think the other thing that's disappointing is they have had changes at the top and an emphasis on a new strategy, and it is falling behind its peers. It's got a lot of strong brands. I appreciate it is, almost exclusively US in terms of the core business. But yeah, it's difficult. And I'm not sure what management are saying that they're going to do, what the strategy is to fix this, which I think, is more concerning. It's nice to have a decent dividend, but it does need to be sustainable in the long term, and they do need to return to growth. And I just don't know how they plan to do that. And I think it is a big worry.
I think as well, if you compare it to the Unilever results, the initial figures are not too dissimilar, but Unilever has so much more foreign currency headwinds.
Yeah.
Whereas, like you say, Kraft Heinz, they report in dollars and most of their business is in the US. So there's just no excuse. Whereas the Unilever underlying results are actually quite good.
Yeah.
So I just don't think they have an excuse other than being the only company in the world that had an extra week in the prior period.
Yeah.
But anyway, of the businesses that we've covered this week, British American Tobacco, Redrow, Unilever, Barratt Developments, PZ Cussons and Kraft Heinz, which do you like the most and which do you like the least?
I would say, tricky one. I'd say Unilever is probably right up at the top this week, and probably up there with Barratt and Redrow. I'd be optimistic for the next year, the upcoming year, I think, with those two businesses. Although the figures, if you just looked at it on the surface, are quite disappointing. Least favourite by far is PZ Cussons.
My favourite would probably be British American Tobacco. That's mainly based on valuation.
Sure.
There's not really a huge amount more to say about that. But I think least favourite, again, it's just PZ Cussons by default.
Yeah.
Because at least Kraft Heinz, the results might be similar to PZ Cussons, but it's probably got more higher quality brands and it doesn't have the foreign currency headwinds. So at least I think it's an easier turnaround job than PZ Cussons.
Yeah. No, absolutely. I think PZ Cussons, if you're going in there as management, and it's incredibly difficult. And like you say, you've just got all of the additional headwinds, and the brands are a lot less strong.
Right. I think that's everything in that case.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.